2023 was filled with strikes across the country, from the UAW to UPS and Hollywood. Thousands of workers took to the picket lines.
And many of them asking for better wages. But as we near the new year, things are slightly improving. We've been talking a lot about that. Mortgage rates continuing to decline, gas prices going down, and consumers, it looks like everybody is spending yet again.
But of course, we talk a lot about inflation. So this morning, we're joined over Zoom by economist Kurt Rankin from PNC. And you guys have seen this guy before, CEO of the Lead Group, Mark S. Lee. Kurt, you're on Zoom. Thank you for joining us. Stick around, because after the break, we'll take a look at one major event, too. But before, let's get to Mark in studio. I mean, I think the big question in everyone's minds is, like, were economists right? Was 2023 the way it was supposed to go?
I don't think so. It's kind of like predicting the stock market. Sometimes you can predict it, sometimes you can't. So 2020, 2023, there was a lot of discussion about high unemployment rates, a tight labor market. So I think it was better than what was anticipated. So I would suggest that the year got better, but it was an improvement of what was initially expected.
You know, we've talked a lot in the last couple of weeks, kind of seeing this uptick in positivity, right? Do we have hope here to be optimistic, or is this just kind of false hope at this point?
No, I think there's realistic hope to be optimistic. I mean, the interest rates certainly have come down. Inflation has come down. Prices are still high in a lot of areas, the staple items, for example. But I think going into 2024 next year, people have reason to be optimistic, whereas people coming into 2023, there was a lot of negativity. So I think that's really shifted to a positive side going into next year.
Yeah, and Kurt, let's get to you, too. What do you think? What maybe sectors stuck out to you the most economy-wise, for better or for worse?
Well, we're still seeing wage growth strong. Detroit's included in this. In fact, some metropolitan areas across the country are starting to see their wage growth fall below inflation. But Detroit's been able to maintain that above inflation, which is a good sign for continued consumer spending. My concern, and I agree with Mark, that 2023 did not play out as expected. In fact, PNC had a recession beginning in 2023 originally, but we've pushed that out to mid-2024, but we still are calling for that recession, because the question is whether or not consumers can actually continue to spend next year at the pace they've been going this year.
And Kurt, let's keep talking about consumers. We saw so many of these strikes in 2023. How will that impact consumers, at least their spending, coming into the new year?
As far as the strikes go, the wage growth that was won as an outcome of those disputes should put those workers in a good position for the next coming years to best inflation. So inflation's not done yet. Inflation's still 3.5%. If you're looking at the core number, the one that the Fed looks at as far as interest rates go and making policy, but that's not going to fall back down to the Fed's target 2% range until the end of 2024 by PNC's reckoning, and that's even coming out of some of the government officials that are not expecting inflation to slow until then. So wage growth that's been won in the labor disputes, or even in the broader economy, it should remain above inflation and provide some purchasing power to those consumers, but there's still a gap to be made up for the last 2 years.
All right, so it's interesting, you know, Kurt mentioned purchasing power. Do you think that the spending is going to continue, or do you think it's going to soften as we head into the next year in the first quarter?
I think that spending is going to continue to increase, but people are still going to be judicious. They're going to be very careful what they're spending. Remember, credit card rates are still high. And so people are going to be cautious about that. You know, cash is always king.
Sure.
But what we found out is that cash, not everybody has that cash, that disposable income that they once had to spend. So I think people are going to be much more judicious moving into 2024 from a business standpoint. If you're an entrepreneur, they're going to also be judicious in terms of how they expend and invest their resources as well, because you have to be.
Do you think, though, that, I mean, typically don't we see kind of a little bit of a I don't want to say a downturn in January, February, as folks kind of, you know, settle in after the holidays and kind of pay off all that Christmas debt? So how's that going to kind of factor into things? I
think that's going to be, you're going to find the exact same thing come January. People get those credit card bills. They're like, whoa, time out. Let me slow down. Let me kind of retrench. But they come February, March, April, people will start to loosen their strings again. But people always take that self-assessment in the month of January, looking ahead into the new year, if you will.
Okay, and let me ask this to Kurt, too. So you mentioned consumer spending is up. Well, isn't that because prices are up too, so that means they have to spend more probably?
Prices are up, people are going to spend more money, but Kurt, I'm going to defer to you from an economist perspective as well.
Kurt, with that, I mean, grocery stores, that's a huge area where people, I feel like, are spending more. Any relief coming at all in 2024?
Well, prices don't go down. Year over year, at least. They might retrench a bit, but they're still going to be up next year versus the last year. We're just not going to see the 5, 8, 9% year over year pace that we saw at the worst of 2022. We're increasing only at 3% and hopefully towards 2%. But food prices, groceries at home have been growing below the Fed's target for some time. Lumped in with the overall food category, though, is eating out. Takeout food away from home is the official category, and that's been still 4, 5, and 6% annualized pace for some time. But people are choosing still to spend that money, and whether that's where the question of whether consumers can continue to spend that money comes into play, because savings, except for the highest income tiers that receive stimulus money, have been exhausted. Again, there's that 3 percentage point or so gap in current wages versus inflation and what's been deteriorated over the past few years. And credit card debt is growing at a pace we've not seen since the late 1990s, and delinquencies on that credit card debt is now above the pre-pandemic level and is rising rapidly.
Okay, good insight. Thank you very much. Again, Kurt Rankin from PNC, and of course, we got Mark S. Lee, CEO of the Lee Group. Thank you, gentlemen, both very much. Stick around after the break. We'll